Hello viewers, welcome to my channel. I am Hashim. So far 10 problems I have completed on computing the income from capital gain. So far we are doing the problems on long-term capital gain, LTCG. After a few more problems we'll start short-term capital gain. There is difference in the tax rates for short-term and long-term. Normally the long-term capital gain is taxed at a flat rate of 20%. Whereas short-term capital gain will be included with other incomes and taxed on slab basis. That is the main difference between long-term and short-term. So in this video, I'm going to start 11th and 12th. Two more problems I'm going to complete in this video. So before starting the lecture, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep ready the problem. Take the screenshot of the points of 11th and 12th problem, then I'll explain. Come on, see the 11th problem. Sri Kiran purchased a building for rupees 3,15,000 in October 2001 and gifted to his daughter Mrs. Jeevani in January 2003. So actually the owner of the building was Sri Kiran, but later on he has gifted the property to his daughter. Now presently the legal owner is Mrs. Jeevani, the daughter of Kiran. Now the income tax has to be paid by Mrs. Jeevani. She got the property in gift from her father. The other particulars are as under. Some additions were made in January 2003 for 2,10,000 and the renovation of the house capital expenditure in August 2005 for 46,800. If the house is sold on 15th January 2023 for 22,10,300 and selling expenses 35,000. If cost inflation index for the year 2001 2200, 2002 2003 105 and 2005 2006 it is 117. Calculate the capital gain. First of all, the new point in this problem is the assessee Mrs. Jeevani, she has not purchased the property. So normally there is no cost of acquisition because the property was purchased by previous owner Sri Kiran. So according to the provisions of Income Tax Act, it's a special mode of transfer. Whenever there is a special mode of transfer like a gift, the cost of acquisition is the cost to the previous owner. So whatever is the cost to the previous owner, Sri Kiran, will be taken as the cost of acquisition of Srimati Jeevani. Right? So that is the new point. In examination, you should write the note. The assessee got the property by special mode of transfer, that is gift. So the cost to the previous owner is the cost to the present owner. That's it. Now, first we start our computation. Mrs. Jeevani, computation of LTCG, consideration received. It is given the property was sold for 22,10,300 minus selling expenses are 35,000. Deduct net consideration 21,75,300. Now we have to deduct the indexed cost of acquisition and indexed cost of improvement. Whatever is the cost to the previous owner is the cost to the present owner. What is the cost of Sri Kiran? Sri Kiran purchased for 3,15,000. That is the cost to the present owner. So indexed cost of acquisition 3,15,000 into current previous year index. Our current previous year is 2022-23. For 22-23, the index number is 331. Always you have to remember that sometimes it may be given in the problem, sometimes it may not be given. So our current previous year 22-23 index number 331 divided by index number of the year of purchase. Actually, the property was purchased in October 2001. That means 2001-2002. But at that time the ownership was with Sri Kiran, previous owner. But the assessee, presently Mrs. Jeevani, got the property in January 2003. So we have to take as previous year 2002-2003. For 2002-2003, the index number is 105. So 331 divided by 105, 9,93,000. In the same month, January 2003 itself, some additions were made. Some additions were made in January 23 for 2,10,000. This is the cost of improvement. The indexed cost of improvement 2,10,000 into 331 divided by 105. Because the additions were made in 2002-2003, 6,62,000. Now, improvement, that is renovation. Normally, renovation will not be considered as improvement, but when it specifically it is given that it's a capital expenditure, that means it's an improvement. So, this indexed cost of renovation we should take. August 2005, 46,800. So index cost of renovation 46,800 into 331 divided by. So the index number for 2005-2006 is 117 given in the problem. So it comes to 132,400. Take the total of these three amounts. You will get 17,87,400. Subtract. Net consideration 21,75,300 minus 17,87,400. You will get 3,87,900. This is the long-term capital gain, LTCG. Simply it is asking you to calculate LTCG, we have computed, that's it. But in working note, in examination, you must write in working note the new point. The new point is special mode of transfer. The SSC got the property by gift, that you have to write. So the cost to the previous owner is the cost to the present owner. That's it. Now I am going to start 12th problem. Sri Ramakant, a non-resident Indian, is leaving to America to settle there permanently. First point is the SSC. Sri Ramakant is a non-resident. He is going to settle in America itself permanently. He sold the following assets in India during the previous year relevant to the current assessment year. Our current assessment year is 23-24. Previous year is 22-23. So during the previous year 22-23, he has sold some assets. Calculate capital gain and income, capital gain income and tax liability if income under other heads is nil. He don't have any other income except this capital gain. So we have to compute the tax liability and capital. So serial number 1, 2, 3, 4, 10 assets are there. For each asset, article name is given, year of purchase, when it was purchased, cost price is given, cost inflation index CIA is given, sale price is given, and use of the article. This is the complete information is given. 10 assets he sold. But Income Tax Act has given which are called capital assets and which are not capital assets. Already in the theory video I have explained in detail. So if you have not watched, I suggest you first you go to the playlist of my channel, select the subject income tax for the assessment year 23-24. Watch the initial theory videos on capital gain. Be perfect about the concept of capital asset, because only capital asset gain will be taxable, right? So some assets are there which are called personal assets. Those are not capital assets and not taxable. First item, motor car. In the theory video I have explained motor car is a personal asset. It is the asset used by the business for personal purpose. So motor car is not a capital asset. So any gain arising from motor car is not taxable. That point you are right. So while watching the video, always maintain the running notes. Always keep a register, pen and a calculator ready. Whenever I explain any important provisions, note it down. Second, house number 1. House is a capital asset. Any gain arising on the sale of the house is a capital gain. So house number 1, house number 2, both are capital assets. TV set. The television is not a capital asset, it's a personal asset. So not taxable, ignore. Painting work, yes. Painting, drawing, any archaeological items, these are capital asset and any gain arising is a capital gain. Then gold ornament is a capital asset. Silver chair, actually chair is a personal asset which is used by the SSC, not a capital asset. Urban land is a capital asset. agricultural land is not a capital asset. Some conditions are given to check whether it is an agricultural land or not. If it is agricultural land in rural area, it is not a capital asset, not taxed. Precious stones, that is a capital asset. So out of these 10 items, 4 items are not capital asset, we should not take. Motor car, TV set, silver chair and agricultural land. These 4 items are not capital asset, so we should not consider. The remaining 6 items we should take. So Sri Ramakant, computation of LTCG for the year. House number 1, house number 2, painting, gold ornaments, urban land, precious stones. These are capital asset. So now we have to compute the income from capital gain, LTCG. Now first, consideration received. The sale price is given for all the 6 assets. In the problem, sale price is given for every asset. 6 assets we have taken. For each asset, 6 lakh, 20 lakh, 25,000, 2 lakh, 930, 510 and 10 lakh. That is given in the problem. Less transfer expenses are not at all given. No transfer expenses at all. So net consideration, same amount. Minus indexed cost of acquisition. Here the purchase was made in 2012, 10, 14, 15, 12, 12, 3, 2, 15, 9. That means all the assets were purchased and used for more than 3 years. So all the assets are long-term capital asset. So gain arising is long-term capital gain. So we need indexed cost of acquisition. So how to calculate indexed cost of acquisition? Take the purchase price into current previous year index 331 divided by index number of the year of purchase. Index number of the year of purchase is given in the problem, CII. Take that in denominator. So here, house number 1. The purchase price was 2,96,000 into 331 divided by 148. 148 is given CII for house number 1. We'll get this 662. So 662,000 is the indexed cost of acquisition of house number 1. House number 2, 4,40,000 is the purchase price into 331 by 220. 662. 36,800 into 331 by 184. 184,000 into 331 by 184. All these calculations you will get the indexed cost of acquisition. Subtract all indexed cost of acquisition. The first house number 1, there is a loss. Because net consideration is 6 lakh, indexed cost of acquisition is 6,62,000. So 62,000 negative. So this is a long-term capital loss. Whereas all other assets, house number 2, painting, gold, urban land, precious stones, all these are positive values. So capital gain. So according to the provisions of Income Tax Act, capital loss can be set off from capital gain. So this 62,000 can be deducted from all these capital gains. The house number 1, there is a loss of 62,000. House number 2, gain, painting gain, gold ornament gain, urban land gain, precious stones gain. So if you take the total, 25,50,800 is the total long-term capital gain. Now it is asking you to compute the tax liability, assuming that you don't have any other incomes, only this income. One point you remember, if an assessee's status is non-resident during the current previous year, if the assessee is a non-resident, then the basic exemption of 2,50,000 will not be given. The residential status of the assessee is non-resident, he is having income from long-term capital gain only. That is, income from other head is nil. If he is having income from other heads, then 2,50,000 basic exemption will be given for all assessees. Non-resident assessees, whether he is a non-senior, senior or super senior. If he is a non-resident, then basic exemption will be fixed to 2,50,000 for all. But that 2,50,000 will be deducted only from income from other heads, not from LTCG. So this 2,50,000 basic exemption benefit will not be given. The complete long-term capital gain 25,50,800 is fully taxable at the rate of 20% flat rate. So hence the entire capital gain of 25,50,800 is taxed at a flat rate. So tax on LTCG, 20% of 25,50,800, 5,10,160. To this, there is no surcharge, because surcharge will be applied if the total income is more than 50 lakh. But health and education cess, that is compulsory, 4%. So 4% on this amount, you get 20,406. Tax liability 5,30,566. Now we round it off 66. Instead of 66, make it 70. So 5,30,570. This is the tax liability. That's it. So in this video, two problems I have completed, 11th and 12th. So if you want perfect knowledge, watch all the videos from beginning till end. Apart from this subject, I have uploaded so many different subjects videos in my playlist. So for BCom, MCom, MBA, BBA, for different courses, even professional courses, CS, CMA, all these videos I have uploaded. So you visit frequently the playlist, select your subject, select the videos, watch the complete video, enhance your knowledge and get confidence on your subject. Inshallah, we will continue the next problem in the next video.